For now, let's invite our alpha manager for the day, Prashant Khemka, who's founder of WhiteOak Capital Management, is joining us. Prashant, of course, founded WhiteOak Capital Management in June 2017, and before that was the CIO of Goldman Sachs, where he directly managed over $5 billion. As last reported, WhiteOak also, he is managing over $5 billion of assets. Prashant, good afternoon. Thanks a lot for joining us. First of all, happy Holi.
Happy Holi, Arush. Pleasure to be here.
So how are you feeling about the market, Prashant? Now we had this one big overhang which was there on the market, right? Which is, some can say out of the way, or at least has started with the 25 basis point rate hike, but the market's actually seen relief rally. Your thoughts?
So I think the Fed hike cycle is occupies or preoccupies the investment community way too much, including media, but also offline, whereas there is hardly any empirical evidence. In fact, I would say there's no empirical evidence that Fed hikes have any negative impact on markets. In fact, what little evidence I have seen at least is to the contrary. And if the data that I have seen is correct over the last few days, it suggests that in the last eight times that Fed has announced the first rate hike, going back 4 decades, the market each and every time has given positive returns. The US market every time has given positive return over the following 12 months with an average return of about 11%. Which is way above the otherwise the average annualized return over time. So I think it's good to have this thing out of the way, the lift off or the first hike. We never associated too much importance to it in any case.
So Prashant, in that case, do you get a sense that the worst for the market might be over, or could we have another round of correction? Because this round of correction was quite decent. I mean, at least in the current run, and time-wise as well, it lasted for long, about 6 months or so.
Certainly, and that's impossible to say. As always, see, we've had 2 very strong years. The market from I'm not saying the bottom of the COVID March 23, which is about 2 years now, but if you look at even the start of 2020, the market's still up 50%. So I'm not saying that's reason for it to correct or to consolidate here or any such things. We don't have any such view. But all I'm saying is that year to date the market is down low single digits now. So it's not that it's pulled back substantially or anything. I think going forward we expect this year, like almost any other year, over the next 12 months or so, we expect low double-digit returns from the market, which is more or less in line with the discount rate or the nominal GDP growth rate over time. And we think that's the most logical expectation to have from the market. And how it actually pays out, plus minus few percentage points, depends on a lot of things going forward. We have the geopolitical situation that's still going on in Europe. The market, obviously, discounting mechanism is already discounting all that, but it's discounting the risk of that. It's the actual outcome you all don't know. Last couple of days, European markets, US markets have done very well. Hopefully, they know something that we as individuals don't know. In which case, the markets might have at least, don't know whether it goes higher or lower, but at least less volatile times might be ahead.
Prashant, afternoon. Rima here. In the last 3 months, a lot has changed. We've got a correction which offers investors a good time to buy stocks which we earlier thought was expensive. Changing external environment, the geopolitical risks have changed the dynamics of the commodity market and the raw materials for so many of the impacted sectors. What are the changes that you've made to your portfolio or the way you're approaching sectors now based on these changes that we've seen?
Certainly. A very good question. And we, generally at all times tend to find better opportunities, greater number of attractive opportunities in certain sectors. That continues to be so, like financial services, particularly private financials, and IT services. I saw some of the names flash on the screen a few minutes ago. So that continues to be the case. At the same time, some in the consumption and healthcare and specialty chemicals basket. But particularly over the last 2-3 months, partly also to mitigate the risk of a commodity price explosion, if you will, on the back of what's going on geopolitically, the team has added a couple of commodity names in metal spec to the portfolio, and also increased their exposure to some of the auto and consumer discretionary names in India. Those would be, I would say, of late what the team has done in the portfolio, besides what it always has continued with, which is fairly high degree of weight in the private financials and IT services.
All right, Prashant, let's take that point forward. Then you said some exposure in metals. Was it ferrous or was it non-ferrous? If you could give us a bit of an indication out there. And also
Both.
autos. Yeah, go ahead.
Sorry, it's both ferrous as well as non-ferrous.
All right, interesting. And on the auto space, I was looking at the current portfolio that we have with us. There was an indirect play via Chola Finance, I think so. But now you're saying you've gone ahead and have taken exposure even to autos. Which part of it? Would it be the PV space? Is it the CV space? Because on ground you're hearing quite a lot of positivity, particularly on the CV side. Go ahead.
No, certainly. So there has been exposure indirectly through some of the financial names. We also have had exposure to auto companies, so say passenger vehicle companies. It's that the team has substantially increased the weight in that exposure, I would say. It's not necessarily a new name in the portfolio, but substantial, very substantial increase in the weight in the portfolio.
Prashant, one space which has made you a lot of money is mid-cap IT. Are you concerned by what's happening, for example, in Coforge with the consistent promoter selling? I mean, is that something that worries you? And in general, your thoughts on mid-cap IT, which is now, the questions are there whether this kind of valuation can sustain. So if you can answer that, and perhaps on Coforge as well, if you can, answer that.
Certainly. No, not certainly. So for some reason, our team has been, and our team's performance has been associated with and disproportionately attributed to mid-cap IT. Whereas
this is the only reason. No, I'm not saying this is the only reason that your fund has done well and has become so big.
I agree. But if you see if someday I share the numbers with you, you'll be surprised that there is no measure of disproportionateness even. Forget about being dominant contributor. It is more or less a mid-cap IT or IT as let's say IT as a sector has more or less been, and for the portfolio, been an average performer. So portfolio has, let's say, outperformed, and IT has outperformed more or less in line, maybe slightly ahead of the overall portfolio. So just that for a minute, because I often get asked about the IT exposure that the team has. So IT has done well, very well for us as well, no doubt. Some of the names have pulled back. I can't, as you can imagine, Anuj, talk about individual names, but some of the names year to date have pulled back more. Partly, they tend to be IT names as an overall sector has underperformed the market year to date after a very strong year last year. Partly, it is the case that IT sector tends to be somewhat correlated to NASDAQ, rightly or wrongly, especially when there is greater volatility. Then that tends to be the case. And since NASDAQ has underperformed this year compared to the other indices, S&P and Dow Jones and whatnot, IT, I think, has somewhat behaved in sympathy with that. And as individual shareholders selling, see, they have their own compulsions. Many of these shareholders may have private equity firms. I'm not talking about any individual company, but what is the motivation behind those sales is also important to understand. Many times they have certain lifetimes of their funds and have to raise cash and so on and so forth. So those are all things that are part and parcel of And it's not the first time also, and not the only company also. There have been several such instances in the past, and that's part of the game.
Okay, and for the benefit of our viewers, Coforge promoters in a span of 18 months have brought down their stake from 70 to now 40%. They've done multiple stake sales in the open market. Prashant, getting back to that point that you spoke about auto, you referred to your team recommending adding to exposure in the passenger vehicle side. Can you walk us through the thinking behind that? Because the latest February auto sales numbers seem to suggest that there is a bit of rural distress. Rural markets are not very buoyant. The chip shortage continues to hurt.
So, no, again, unfortunately, I can't go into more specifics of an individual company, and to talk about generally as a sector is not consistent with our investment style, because we are a very stock specific. But to the specific points that you talked about, the passenger vehicle and the rural demand, see, stock prices, as you know, Rima, very well, they are discounting mechanism. So current weak environment was maybe discounted few years ago, right, in the stock prices of these individuals. Let's take an example of the COVID crisis. Market bottomed on 23rd March 2020, when cumulative number of deaths in India till that date was just 5. The COVID case count that day was 75, not thousands, just 75. And then so much pain that the country has witnessed and the world has experienced from the pandemic. But the market prices have, rallied. The markets have rallied tremendously because markets looking at the future. And same is true for the market, and same is true for the individual companies. So I would say in passenger vehicle segment or any auto segment, the market is not overly occupied or preoccupied with current sales figures. And more looking at what the future, and not by future I mean not just what next year or the year after, but what the longer term might hold in terms of growth potential, cash flow potential, profitability potential. Rima.
Well, Prashant, final question then. On the FMCG names, some of them have seen a sharp correction from the top. I think you all have got some new hands as well into your team, fresh thoughts as well coming in there on the FMCG space. HUL, they have been talking about rural distress, stock is down close to around 40% or Godrej Consumer as well, change at the top, but still the stock is faltering. In this fall, have you all added FMCG names, or are you all still in wait and watch mode?
So we have a decent number of companies in the portfolio, or overall allocation in this segment. Not too many companies, but very few select companies in the portfolio. And we haven't, I don't recollect the team having made any substantial changes over the last few months in that area.
Prashant, it's always a pleasure to talk to you. Thanks a lot for joining us. And no, I didn't infer that your outperformance is only because of IT, though of course because a couple of these stocks stood out. So we obviously asked, since you have offered, now I'll take this offer of perhaps coming over to your office and trying to understand your fund dynamics and some of your investment thesis. Sure, I'll touch base with you, and of course be there. Thanks a lot for joining us.
Thank you. Thanks, Anuj and Rima. Bye.
Okay, let's move on then, and of course time for D Street Chatter.